We can start by writing and saying that this is a statement. This is a statement prepared by a manufacturing entity. Prepared by a manufacturing entity to determine the total manufacturing cost or production cost. So manufacturing or the production cost. Production cost. Then write and say that the manufacturing cost is comprised of one, the raw materials, two, we have the direct labor, three, we also have royalties. If they are there, four, we have the overheads. We have the overheads. So another point we can write and say that the material cost, the direct labor cost, royalties, and any other direct cost or expense. Make up the prime cost. In other words, it's called what? Prime cost. This is the total value of all direct costs. So we write and say that the overheads are allocated to the manufacturing account, either directly or proportionately. So some of the direct overheads, it's something like maintenance of plant. That's a direct overhead. Maintenance of plant. It's a direct allocation to the overheads. Also, depreciation of plant or machinery. Depreciation of plant and machinery. So these two, they are directly, in other words, they are allocated 100%. We allocate them 100% to the manufacturing account. Then the others, they can be apportioned with regard in consideration on what the examiner has said. Either the set percentages, the set ratio, it depends on the proportion given. Depends on the proportion given. So you write and say that the goods produced, the goods or units produced, the units produced, the goods or units produced are transferred to the sales department. The sales department where their selling price is determined, where their selling price is determined. Their selling price is determined and sold at a given margin or even markup. Margin, that's a profit on sales. Markup is the profit on cost. 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 So I think there is not much to write. There's not much to write. You can write and say that the manufacturing account is presented. The manufacturing account is presented as follows. The manufacturing account is presented as follows. So you're gonna have ABC Limited manufacturing account. Manufacturing account for year ended 31st December. We can use just 2022. This is just the format. So we start with the raw materials. We start with the raw materials. The raw materials, you key in the opening inventory. You add purchase of materials, that's the purchases of raw materials. If there is any carried inwards, you add also carried inwards. If there are any materials returned, that's return outwards. That one you less. Then you also less the closings inventory. Closing inventory is less. And what you get here is the raw materials consumed. Raw materials consumed. That is the raw materials consumed. Then we add, direct labor. We also add royalties if they are given. And also you can add any other direct expense. Any other direct expense. And once do that, what you get here is now what we call the prime cost. This is a total of the direct costs. is a total of the direct costs. Is a total of the direct costs. Then next, we key in the overheads. Yeah, now the overheads. We key in the overheads. For the overheads, we're gonna have plant maintenance, can also have depreciation on plant and machinery. I say easily, you record them 100% unless stated otherwise. Unless stated otherwise, you record them 100%. 100%. There are things also known as loose tools. Determine how much of them is utilized. Can also have factory power. You can also have indirect wages or salaries. Those are also direct, unless also this one, the factory power, that's our direct one. You can have, there is many. You can have electricity, sometimes combined with water. Kama iko, we just key in that which we have been provided for. That which we have been provided for. That which we have been provided for. Can have rent. We can have insurance. So these costs or these expenses, we allocate them. According to the proportions given. So they can be as many as possible, and also they can be few according.
Excuse me. Let me key in those items. I just lost my internet from the overheads. Just a minute.
So I just was saying that they can be as many as possible or even as few as possible. Then from there you add the opening work in progress. Then you less the closing work in progress. Closing work in progress. So what we get here is the manufacturing cost. Manufacturing cost. If those goods have been sold, they have been sold at a profit, we call it. That means you add the manufacturing profit. Once you add the manufacturing profits, you get the sales, and we call it the transferred value. That is now the amount, that is the selling price. That is the selling price. So after the manufacturing account, you might be told to prepare the income statement. And the income statement is just the normal one that we prepared before. The only thing which changes is the cost of sales. We use different items. So we can just write in income statement, cost of sales items, income statement, the cost of sales items. How do we determine the cost of sales? The sales is zero. we less the cost of sales, and the cost of sales is made up of the opening inventory of finished goods. Opening inventory of finished goods. Then you add either the manufacturing cost, and if the goods were sold, you add the transferred value. So either the manufacturing cost or the transferred value. That's if the goods were sold, the transferred value. Then you less the closing inventory of finished goods. Closing inventory of finished goods. Every other thing remains as normal and remains the same with other income statements that we have prepared before. So let's read the question. Bolt and Nut Limited is a medium-sized manufacturing company. The following trial balance was extracted from the books of the company as of 30th September 2020. So we have the ordinary share capital, share premium, retained profits. Those are items of the statement of financial position. We have allowance for unrealized profits. Allowance for unrealized profits. We'll calculate the current allowance for the unrealized profits. And the unrealized profit, we take the finished goods, that's the closing stock of finished goods, we divide by the transferred value, then we multiply by the manufacturing profit for that year. And we'll do that. Then we have motor vehicles expenses, bank balance, dividends paid, accounts receivable, accounts payable. We have inventories as at 1st October 2019. Those are the opening inventories for raw materials, work in progress, and finished goods. Purchase of raw materials, their direct labor cost is given there. Then we have factory general expenses. Factory general expenses, they have been separated into variable and fixed. Variable and fixed. Then we have administrative expenses. We have rent, electricity, stationery and postage, and also the staff salaries. We've been given the sales. We have plant and machinery at cost, and also its accumulated depreciation. And also we have motor vehicles, which was for deliveries. We have its cost and also the accumulated depreciation as at the beginning of the year. And additional information, we are told that inventories as at 30th September 2020 were valued as follows. Those are the closing inventories for raw materials, work in progress, and finished goods. Then now number 2 says, finished goods are transferred to the warehouse at a cost plus markup of 25%. That means now they are being transferred to the sales department or to the warehouse to await for their selling. And they are being transferred there at a markup of 25%. Markup, that is a profit on cost. So we'll calculate 25% of the manufacturing cost or the production cost. Then we add it to the manufacturing cost, we get the transferred value. Depreciation is charged on a straight line basis as follows. So depreciation under straight line method equals to rate. We multiply by the cost of the asset. Then information number 4 is at 30th 2020 accrued direct labor cost. Accrued direct labor cost amounted to 6 million, while prepaid rent amounted to 4 million. Accrued direct labor cost. Direct labor, it's a cost. It is a cost and it is accrued. Accruals at the end of the year, we add to the generally given cost of the expense. Then it is also treated as a current liability in the statement of financial position. Then we have prepaid rent, prepayments at the end of the year. We subtract or we less from the general given amount of the rent expense. Then prepayments are later treated as current asset in the statement of financial position. Required manufacturing account and the statement of profit or loss for the year ended 30th September 2020. So we put down that information. We come up with the manufacturing account. Then after getting the manufacturing account, we continue with the income statement. So they just combine them. So we have these, they are calling themselves gold and NAT Limited. We need the manufacturing account and income statement, or the statement of profit, or loss. Income statement for the year ended 30th September 2020. The end of that is September 2020. So we start with the raw materials. These figures are in thousands. We start with raw materials. And we start with the opening inventory of the raw materials. Opening inventory of raw materials were given as 14,000. We add purchases there. The purchases of raw materials were given as 76,000. Then there was no carriage inwards of any cost related to purchases, so we left the closing inventory given in additional information 1. Closing inventory of raw materials given as 18,000. So we left this. And what we get here is the materials consumed, raw materials consumed. Materials consumed. Materials consumed. So this one will give us how much? This is 14. If we key it in here, we get -4. Key it in here, we get 72,000. Is that so?
Yeah, 72.
That is the materials consumed. Then we add the other direct costs of direct labor cost. That is direct labor. We are given it as 56,000, but it has an adjustment. We were told that there was an amount of the direct labor which was accrued at the end of the year. That is additional information 4. So we add the 6 million. And the figures are in thousands, so we pick 6,000. So the direct labor will total now to 62. It total to 62,000. And there was no royalties given there. And also there's no other direct expenses. There are no other direct expenses. Cost. So these will give us the prime cost. This will give us the prime cost, 104,000. 104,000. We have that. Then also now we add the overheads. We add the overheads. The overhead cost. Overhead cost. So let's pick from the trial balance and see the ones which are direct. And we can start with the factory general expenses. Factory general expenses. They have been separated into variable And variable, we are given that's 2,000. And fixed 18,000. Fixed 18,000. 18,000. We are not given any information about proportioning or allocation of the other expenses to this manufacturing account. So we take depreciation on plant and machinery. Depreciation on plant and machinery. Depreciation, that is for plant and machinery. And in machinery, we are told that depreciation is provided at 10% on cost. So we take 10% of the cost of plant and machinery, which we are given as 60,000. 60,000. So here we have 6,000. We have 6,000. And those are the only two overhead costs which are coming here. The other admin expenses, unless we have been told that they were allocated to this manufacturing account or to the factory at a certain amount or percentage or proportion, we cannot key in them here because they were not directly incurred. We've just been told that they were admin, they were not related to the factory. So what we get here is the manufacturing cost. Manufacturing cost. So we add prime cost plus these three costs. We get the manufacturing cost. So 134 plus 32. This itself is 50. This is 50, 56. 56 plus 134. That is 190.
Yeah, 190.
190. Oh. Sorry. Before we get this, we have left two items here. We add, sorry for this. Before we get that, we add the opening work in progress. Opening work in progress. And the opening work in progress we were given under the inventories 10,000. Then we less the closing work in progress. Less the closing work in progress given under the inventories. Information number 1, 16,000. Now we can get the manufacturing costs. Now, ilikuwa ngapi? Ilikuwa 190, sio? 190 plus 10, that is 200. 200 minus 16.
184.
Yes?
184.
184. 184. That is the manufacturing cost. That is the manufacturing cost. Then additional information 2, we have been told that the finished goods are transferred to the warehouse at cost plus markup. So this was the manufacturing cost of the finished goods, okay? So we are told that they are transferred at a markup. So we add the manufacturing profit, which is at a markup of 25%. Markup is the profit on cost, manufacturing profit. We take 25% of the cost. 25% of 184,000.
46.
Yes?
46,000.
46,000. So if we add the 46,000, we get the transferred value. We get the transferred value. We get the transferred value. So itakuwa 230,000. So that is the manufacturing account. That is the manufacturing account. That is the manufacturing account. We continue now and key in the items for the income statement. So tunakuja tu hapa chini yake. We have sales. Continue now with sales. Sales, we are given an amount of 384,000. We're given an amount of 384,000. Then there was no return inwards. So we less the cost of sales, less the cost of sales. The cost of sales is made up of the opening, finished goods, opening finished goods, and we're given an amount of 13,800. We add the transferred value, of 230,000. Then we less the closing finished goods. We less the closing finished goods. And the closing inventory for finished goods is 2,700. So we have 13,800 plus 230, that is 243,800 minus 2,700. It's giving us an amount of
223,100.
223,100. 223,100. Then we less that, we get the gross. Less that, tunapata the gross profit. We get the gross profit. Allow me to record it up here. We'll get a gross profit of how much?
160,900.
160,900. 160,900. 160,900.
We have written 160.
Should be
160,900.
Oh, 160,900. Not 1,000. 160,900.
Not 1,000.
Yes.
Yeah.
Then let's see whether we have any income which is related now to this company. And I didn't see any income, right? There is no income there. So we less expenses. Less expenses. Less expenses. And the expenses, let us first pick the administrative expenses, all of them. The administrative expenses. We have the administrative expenses, and under the admin, we have rent, but that rent had a prepayment. The rent is prepaid. The rent is prepaid. So rent, it's given as an amount of 38,000. Then we minus 4,000, which was prepaid. So that will give us an amount of 34,000, right?
Yeah, that's true.
That 4,000 we less. And now we can key in the others. We have electricity. It had no adjustment, 12,000. You have the next one, stationery and postage. Stationery and postage, 4,000. Then we have staff salaries, 38,760. 38,760. 3760. Then we calculate depreciation for Motor vehicles, depreciation. That is for motor vehicles. Depreciation for plant and machinery to take up manufacturing account. So it's 25% of the cost of motor vehicles, that's 2,000. 25% of that 2,000 is how much?
8,000.
8,000. 8,000. Then we have now the provision or the allowance for unrealized profits. The allowance for unrealized profits. Allowance for unrealized profit. We have the one which is given there, the trial balance is at the beginning of the year. But now let's compute. Sorry, let's compute now the allowance for unrealized profits this year, the current year, is at the end of the date. Is at the end of the date. So allow me just to calculate it up at TV so that we bring it up at you. We'll see whether it increased or decreased. Allowance for unrealized profit. Allowance for unrealized profit. Allowance for unrealized profit. This one we get it through. We get it through. We take allowance on the allowance, the provision equals to closing inventory for finished goods, closing inventory for finished goods, closing finished goods. We divide by the transferred value. Then you multiply by the manufacturing profit. Multiply by the manufacturing profit. By the manufacturing profit. So if you calculate it, the closing finished goods equals to 2,700. The transferred amount is 230,000. You multiply by the manufacturing profit of 46,000. So this one will be how much? 2,700 divided by 230,000 times 46,000. It will give us an amount. Yes.
4,140. 4,140.
4,000.
140.
4,140. 4,140. So it increased. The given allowance in the trial balance is 2,760, right? So you look at 760, you can add 4,140. So that increase, we put it here as an expense. Increase in allowance for unrealized profit. Increase in allowance. Increase in allowance for unrealized profit. Increase in allowance for unrealized profit. Take the 4,140 just minus 2,760. It will give us an amount of
1,380.
1,380. Then we can get the net profit. You can get the net profit. You can get the net profit. There's an expense we have left. Naiona pale juu. Motor vehicle running expenses. Motor vehicle running expenses. Kindly include it. Motor vehicle running expenses. Motor vehicle running expenses. Sorry, I had not seen it. Motor vehicle running expenses include motor vehicle running expenses. Of 9,000 to the running expenses of 9,000. Yeah, now we have keyed in all. So now you can have the net profit. You can have the net profit. So as just as I've said, we forgot to add the manufacturing profit up due, so we just added HAPA manufacturing profit. It still has the same effect of 46,000, right?
46,000.
46,000. Then we also add now the retained earnings from the previous period. Retained. We have the retained profits. Retained profits, and we are given them as 16,000. 16,000. Then we will less dividends paid. We will less dividends. Less dividends. So now we can know how much profits did the company remain with, or how much did they retain at the end of the year. Dividends paid are 23,000. Dividends paid. That is 23,000. So we less them. There is no transfer to reserves. Yeah, so we close it at that. So we get the retained profit now as at the end of the year. Retained profits. Retained profits. Retained profits. Now the retained profits now is what we carry and included it under equity in the statement of financial position. So this one is 53,760 plus 46,000 plus 16.
It's 92,760.
92,760. So that is what now we carry to the statement of financial position.